Hello, class. I just want to thank everyone for all your great postings, hard work so far. I wanted to take a few minutes and start some work on the practice problem. So there is actually a practice problem that I find very useful when working on the assignment. So the first thing I want everyone to notice is that there is a download. So you have actually a download with financial information. So on the sheet, you'll download that. It has last year's and current year's balances for cash, accounts receivable, inventory. Um, you've got prepaid insurance. So you have all the items that you need to actually compute the ratios that you see over to the right. Now, I want you to keep in mind, this is actually, you want to say pre-filled for you. So the object of this is that you accurately put in the balances for the various accounts. So the current year and the last year balances. And then as you see over to the right, the ratios are they're actually calculated for you. So the big thing is making sure you get everything properly put in. Then the other portion is for you to perform an analysis based on this information. So the other thing I want to point out is when you look over here to the right at the comments, it actually gives you the formulas for the various ratios. So you've got return on equity, so you've got net income divided by average equity, return on assets, net income divided by average assets, net working capital are your current assets minus current liabilities. So this spells everything out for you. You just have to make sure to actually go in and put in the correct account balances. So let's do that. So let's look at the current year. So for cash, we've got 15,000. For accounts receivable, we have 25,000. For inventory, we've got 60,000. And then for prepaid insurance, we've got 5,000. For long-term assets, we've got 200,000. And for accounts payable, we've got 20,000. And then notes payable due in 10 months, we've got $10,000. And then we've got wages payable, we've got $9,000. So keep in mind, you see things starting to fill in over there when we look at the ratios. Long-term liabilities, we've got 70,000. And then stockholders' equity is 196,000, and then 250,000 for sales. Okay, and then cost of sales 175,000, and then we've got net income is 20,000, right? So we got 20,000. Remember, this represents the current year balances for these accounts. So we've got some balance sheet accounts, and then net income, and the sales, we've got actually income statement accounts. So let's look at last year's account balances. So we got 15,000 for cash, so there was no change there. We've got accounts receivable, we've got 25,000. We've got 60,000 for the inventory. And then we've got 5,000 for prepaid insurance, 196,000 for long-term assets, and then we've got accounts payable, 25,000, and then we've got notes payable, that's 15,000, and then wages, so that's 5,000. And so that went up. There's wages payable. Then we've got long-term liabilities. We've got 75,000, and